Before we jump into this episode, I'm excited to announce our brand new AltDoc HELOC product. That's right, the wait is over. Fund Loans has a second position home equity line that uses 12 months bank statements to qualify. We can do loan amounts up to $500,000 and CLTVs up to 90%. Inquire today at fundloans.com. On this episode, I get the pleasure of speaking with Mark Wilson. Mark is a CPA and managing partner for CWDL, a CPA firm specializing in the mortgage industry. Prior to starting the CWDL CPA's firm, he launched and eventually exited GEMC, which is a privately held mortgage bank located in San Diego. In addition, he's served as CFO for multiple financial service firms, participated in raising capital in merger and acquisitions transactions. Mark and I speak about what's driving success for certain brokers and why others are failing. Listen close as we explain why brokers should be focusing on jumbo loans and non-QM. And last but not least, we discover and share one of the most unique ways to get referrals from CPAs.
Welcome to the $1 Million Mortgage Experience Podcast. Listen in as CEO John Maddox of Fund Loans reveals tips, secrets, and origination ideas to fill your pipeline with $1 million opportunities.
Welcome to the show. We're here with Mark. Thanks for showing up, Mark.
Yeah, happy to be here.
Yeah, so you have a CPA firm, but it's more mortgage-centric, right? Tell us a little bit about that.
Yeah, so I'm managing partner of CWDL Mortgage Banking CPAs. We're a firm that specializes in the space. We do some of the more traditional work of audited financial statements, full-blown tax returns, multi-state, special allocations. We do tax credits for mortgage banks all over the country. And then we do some of the non-traditional work, which is consulting, accounting department outsourcing, full from accounts payable all the way up to CFO level services. Mm-hmm. We provide a full service related to that need. We just kind of discovered through the years of servicing this industry that it's hard to find good accountants. Yep. It's hard to find accountants that understand mortgage banking, accounting like A&B and Loan Vision and QuickBooks certainly. So we've trained all of our people in that. So that's another big service that we've seen a lot of growth in the last couple of years. But yeah.
So one of the benefits, I guess, of being where you are in your chair is you get to see like what these mortgage banks are doing. You can see if they're suffering from losses. You can see if they're, this quarter from that quarter to that, and the next quarter, you get to see kind of where they're at financially. And then you meet with them, right? And you get to ask them like what they're doing, kind of you find out what, what's causing the good or the bad necessarily.
Yeah, absolutely. Yeah.
So tell us like what's the general pulse or temperature of the industry right now?
Yeah. So we're just finished up closing out all of 2018, right?
Oh,
so 2018 financials were due March 31st, which was just Sunday.
Okay.
And so last year, I would say overall, most companies had a very difficult year. Production was down.
Yeah.
But in turn, what we've seen in addition to that is the first quarter things are up. So although we're upset about last year, they're very optimistic about what's going on in 2019. Mm-hmm. Where we look and we track new loan apps and see how that's building. And most pipelines have been building over this quarter. Mm-hmm. And so people are optimistic right now. I don't think there's more optimism, I would say, going into 2019 than there was in 2018.
Interesting.
It's been a big difference.
What do you think is causing that change in optimism?
I think there's the non-QM space certainly is giving people some additional hope for growth, better margins. Mm-hmm. In 2018, the secondary market wasn't the appetite for the asset class wasn't mm-hmm. very good,
right? And
so that decline in that appetite drove the overall price down for mortgage banks.
Yeah, I kept hearing margin compression.
Yeah, it was very difficult. Some of that is coming back a little bit, but I think still in your traditional space, there's still a fallout of some of that margin that wasn't here like in 2016, for example, which was a great year, right? 16 into 17, yeah.
Like companies like Impact and I think Cash Call, like I heard they're publicly traded, so you can see their financials, but they had pretty big losses, and I know that. After,
so that overall, that whole asset class was off 30 basis points at least. So overall, just because there's other assets in the secondary market that people were more attracted to, and it's pretty simple economics, right? So there's not enough room on these loans that they can make enough money.
The broker a point or two or whatever it is, and they got to make their branch margin, and they got to make their
right. And the cost per acquisition is not going down. The cost to manufacture a loan has not been going down. So some stats you look at the average price to per loan is almost, it was inverse in the average amount made per loan on a gross basis.
Jeez.
So, even people that had an increase in production, if they weren't paying attention to margins, were losing money. So more, the more they originated, even more they lost. So that was a very difficult year for a lot of clients, and not all. Some clients were really, they paid attention to that, really controlled their cost structure, and had a good year. But I'd say the vast majority had taken some substantial dips in their overall net worth due to losses.
Do you think that there was some hesitancy to get into the non-QM space from a lot of mortgage banks?
First of all, the name non-QM has got to be the worst name ever. Like whoever the marketing, there was no marketing person. I don't think
this is not a qualified mortgage, but we're going to do it anyway.
Yeah, it's non-qualified. They should call it something different. Because it actually, it is a qualified. It's you have to qualify for this mortgage. So I think there's hesitation in a lot of people got hurt in the last run up when kind
of. About pre-crash,
pre-crash,
07,
right? When there was a big run up and the Alt-A and the subprime era, and I think as a result, a lot of people who are in the business back then,
the ones that made it through,
looked at non-QM and they're like, oh my God, we're returning to something that was bad overall for the industry.
Right.
I don't look at non-QM in that light at all. I think non-QM as a different type of product is nothing. It's a lot different than that product back then. So I think there has been some hesitation to it.
Well, I mean, you're looking deeper into someone's tax return. No, I mean, you're looking deeper into their financials. So you're looking at every bank statement. You know that when their wives or whoever's getting their nails done, they're eating at Taco Bell or In-N-Out Burger, whatever. You see every detail, and you see an NSF if they're spending more than they make. You can tell. You can't tell that on a W-2. You can't. You just see they make pretty good money. You can't see their spending habits, so you can't really know much about them other than what the government says on their return or whatever.
Yeah, I mean, this is not a new concept, right? So if you wanted to get a consumer loan and you're a business, you could give access to your bank statement, get a decision ran on whether or not you would qualify for that loan, literally in 4 minutes, right?
Right. They
look at your deposits. They can source it through AI, understand whether that's income or it's debt or whatever. So the future of this business, I think, has to change. I think partially the whole underwriting process might change, even from an agency perspective, and even govies in the future. There might be a change in that environment in the future.
And technology as well. I mean, I think in general, the mortgage business is behind in technology. I think the crash just sort of set a lot of companies behind for a while.
Yeah, it's from a technology perspective, it's super fragmented.
Right.
Your front end doesn't talk to your back end. It doesn't talk to your lead source,
sure,
contact management system.
Unless you fork out a ton of money for like Salesforce or something,
right?
Then maybe you get it. But like you're in this business, you see all the different nuances, day to day and quarterly, monthly KPIs of businesses. What's driving the guys that are doing well? Like what's driving that? Is it direct to consumer platform, or what's been working in the industry?
So
Obviously non-QM you said, but what else is driving it? Like,
I think companies who know themselves and know what they're good at seem to do better. And what's that mean? You know,
Sure.
there are people that want to specialize in a particular niche and have a particular source for where they get their business. That might be somebody that specializes in VA, for example,
Sure.
and they know how to own that market. So
Right.
they feed that market through maybe a consumer direct model or relationship driven, right? The opposite is true for like wholesale companies that go out and find brokers who, first of all, make good relationships with brokers who turn in quality business,
Right.
and have a good source of leads, right? So
Yeah.
obviously we're CPAs. We get tapped on the shoulder often from
mortgage guys?
For mortgage guys, right?
hey, do you have any referrals? Do you have
Got
any
any referrals?
What do
Yeah.
you do? Do you just shut them out, or do you have?
I just want to
do
get a coffee, which is
What
fine.
works, by the way, with that? Because that's true. I mean, a lot of our viewers are probably kind of knocking on CPA's door saying, like, hey, I know that you know these people that I can help. Like, what would be a good approach?
So, like, personally, even in
Yeah.
my own life, right, we're going to refer people we trust. And
Yeah.
who do we trust, right? If I have a client that I've known for a while who comes in and they happen to be a loan officer, and I know they're going to take care of my other clients really well, I'm going to be really open to referring somebody to them, right? And
Right,
understanding what they do.
Sure.
So I think starting with the people you currently do business with is the easiest way to create a referral source,
Right.
which also means that you should be doing business with people that are successful, that have a book of business, that deal with people that maybe are high net worth type of, especially in the non-QM space, that are self-employed. Maybe you go to a CPA firm that has a lot of entrepreneurial perspective, a lot of entrepreneurial clients, and get to understand what they are, because you can build that relationship, which can be, I think, super valuable over the long run.
Do CPA firms advertise that they specialize in entrepreneur type of
You
business?
can interview CPA firms, right?
Right.
You can say, hey, listen, I want to come on board. I'm looking for somebody who does a lot of
business owner
work, and as opposed to somebody who might just do individual tax returns. There are CPA firms that specialize in individuals that have stock options in all these different areas. And just creating figuring out who your avatar client is, like what's your best client, and then finding people that serve that particular group, it goes a long way, right?
That's cool.
There might be some small firms that are just individuals and they're just getting people who actually need like a tax professional for the first time. They're just getting ready to get in that space, and they might be an EA. It might be a smaller type of firm, and that might be your target group. But it's just understanding, I think, who you're serving goes a long way.
That's
so
good.
I've seen that.
So you're an entrepreneur. I know you did some other things besides just getting into CPA work. What kind of, how'd you get your start in the mortgage? Like, why did you get into mortgages? And focus on that.
It's funny. I always say it kind of chose me, but I initially worked for a firm that used to audit brokers, and brokers had to be approved through FHA, or they had to get an audit done to be able to originate FHA loans.
Right.
And so we started auditing mortgage companies, and I met a bunch of loan officers, and I was a young guy right out of college, and I went, boy, these guys are making a ton of money, and I want to know what the hell they're doing.
Right.
And I just got done killing myself getting out of school, and I wasn't making anywhere near what the loan officers were at the time.
You
and so
see their financial statement, you're like, damn.
I'm like, man, what am I doing? So I just started learning it, and it just intrigued me, and I got real interested in it. I was able to build up a book of business with a bunch of mortgage bankers as a result, and I kind of learned it from that side, and then eventually built that company up in my own book of business, and was able to sell my own book of business, and took a job with a seller and servicer of debt. We bought debt and sold it, and we raised a bunch of money, and that company had an IPO, at least the founders did, and then I went to I was recruited out of another mortgage bank to be their CFO. That company was doing about $20 million a month in originations and ran it up to over $80 million a month, and really learned a whole lot through that experience on taking on, how to sell loans, to investors and Wall Street firms, and what hedging was and derivative assets and all these crazy things. So you got to learn when you're on our side.
Right.
And ended up exiting that company and started my own mortgage bank, raised money, put together warehouse lines, even did a private warehouse line. And then exited that company as well.
Was that in like the 2000s?
Yeah, in 2000s, okay. And then came back. It wasn't the most exciting exit, I will admit. It was more like, holy smokes, I gotta, not get too hurt here. But I did end up selling that company, and then started this firm. And I think what has kind of allowed us to grow in this space is really being not only on the side of public accounting, but being on the other side, being an owner, understanding loan officers and the relationship with the ownership and that perspective, and understanding secondary markets and all that. Good. So that's why we fell into this specialty.
Cool.
Yeah,
that's cool. So yeah, I mean, it's really cool to see that you are able to kind of find out what's working. So like, tell our viewers, if you can kind of think at some of the P&Ls that you looked at, like, can you tell like when it makes sense to buy leads? Like I know a lot of people invest money in mailers and invest money in lead purchases. Like, do you have any clients that like, wow, that's working? Like, you can see from a perspective of like, I've invested this much money and now I'm getting this much return because it's returned this many loans. Is that something that you can think of? Or is that more?
Are you talking about what type of leads they're buying, or when it so just from a high level, so 30,000 foot view, it's really when we talk to owners, it's cost of acquisition, right? So we look at how much does it cost to get the loan into the company, right? And you're either paying a loan officer, or you're paying a loan officer and a lead source, or you're paying one or the other. So it's understanding who owns that relationship with the actual the customer, the borrower, right? And so you have to look at it in the aggregate, right? If you're a business owner, how much can I afford to pay a loan officer? How much can I afford to pay Zillow or a Trigger Lead or something coming out of Experian? We have people that pay.
Do Trigger Leads work? Like,
they do.
People crushing it with that.
Yeah. So if say you want to specialize in a zip code, for example, right? And so you can pay Experian to send you a notification that anybody goes and gets credit for a mortgage in your particular zip code. You can pay them to give you an idea of when somebody's coming out of 10 years of bankruptcy, and all of a sudden their credit's going to improve. You need to get notified that, hey, this person's might be coming due. And so finding those sources can be really
valuable. Is that through Experian Direct? Like you would call
you go Experian Direct. There's also
Let's get
Deluxe, also the check writing company.
Okay. Yeah, Deluxe.
They also do Trigger Leads for that. And then, obviously there's your traditional bank rate, and there's a real art to when you call on those. A lot of people think that they do consumer direct and they buy these leads, and as soon as they get it, they call right away. Well, even though there's exclusive leads, everybody's selling
really
that. I don't know how exclusive they really are, because
that means 3 or 4, right?
Yeah, and so that person gets called immediately by
like they're the best technology, I'm sure, out there. Like
so they're getting called by 50 people, but they're probably just starting the process. Yeah. So creating a process of following up on those particular initial leads that might feel dead, they might be. You have to know your customer, but they might be really 60, 90 days out. So maybe the most valuable time to call that lead isn't the day that it comes in. It might be 90 days down the road. So
we did a podcast it was a Mortgage Minute about buying aged leads, and I was buying them for like under $5.
Yeah,
and I could go cherry pick the jumbo ones, and it cost me like $3 or $4. And it said like, they were sold 1 or 2 times and they were 60 days old. But I would call them and literally they'd be like, oh yeah, I didn't get qualified. Especially if you get jumbo leads with maybe a little bit lower FICO.
Yeah.
It's really hard to get a jumbo loan, at least a good jumbo loan with a FICO under 720.
Yeah.
So there's a technique to all this. Like you can literally.
There's an absolute science. It's knowing, we say your avatar, like who you're trying to get, right? And it's really important to know and to get in their head. When I was the CFO of the seller and servicer of bad debt, we would buy the debt for pennies on the dollar, like 3 cents, call it, right? And people think that it's most valuable when you buy it. It's not. We would get a trigger lead when that person would, what happens, people go through a decline in income and they start to suffer. They get bad debt. It gets written off. And as time goes on, they start to come back, bounce back. And so they go and get the credit pulled for like a cell phone. Well, we knew at that point in time that became a better deal because they are ready to return to good credit. So we can give them an option to solve it. Same is true with these trigger leads for Experian or even the leads that come in through like Bankrate or Zillow or whatever, understanding what's the normal cycle from start to finish on those leads.
So one of the trends that I've been seeing in the marketplace is banker to broker. So you see like companies like C2 crushing it because they're adding all these different brokers, and there's a migration really from some of these bigger bank kind of lenders to, and maybe they're not banks, but they're like banker or they're like lenders, and so there's loan officers leaving these lenders and they're going to work for either starting their own broker shop or they're becoming a broker and just making that migration. Have you seen a little bit of that trend? I know at the conferences I've seen it.
Yeah, so we deal primarily with the banker side.
Right. So
we're not, we see guys that start off as brokers and want to become a correspondent banker.
Right.
And the correspondent becoming, to a mid-sized mortgage lender, right?
Yeah.
And to becoming even servicing their own portfolios through Ginnie, Fannie, Freddie, whatever.
Right.
And so I would say in the last 5 years, I haven't seen as much of that migration through our practice, but that's not to say it's not happening. I'm sure it is. I'm sure it is. But
well, especially with margin compression, I think what you see is that a broker can get better options than sometimes a bank if they only have certain investors. But interesting to see. So what about as a entrepreneur, do you think there's a difference? Because like we get paid on BIPs, right? So as loan officers, the amount of work that goes in, and I know in your KPIs you see like how much it costs to do a loan, right?
Right.
And so it only would make sense then to work on bigger loans, right? Because if your cost to do a loan is X, if you did a loan that was twice as big, you're going to make double the revenue, typically, unless your margin compresses. But, in non-QM, I think the margin is fairly kind of even, whether or not it's a smaller loan or a bigger loan. Would you say that jumbo loans are something that people should focus on, knowing that as kind of a numbers guy?
Well, I think as a loan officer, I mean, jumbo loans are yes, you can make more per loan if it's the right product mix.
Right.
What I see across the board, and most lenders, most correspondent lenders in particular, will set a max commission on a jumbo loan. And the reason is because you're competing with big banks for that jumbo business, and the margin to the mortgage bank is much smaller.
Right.
And as a result, so you have to measure that max payout to what something less would, something on a lower or a smaller scale would be.
Sure.
However, on the non-QM, you don't have that same margin limitation. Right. And so...
especially if you're a broker too.
Yeah, and especially if you're a broker, right? And so you can set your own amount, right? As long as you can sell it.
Yeah.
Yeah.
I would say most of our viewers are all brokers. So,
Yeah.
I mean, I know there's some lenders watching too, but, we're a wholesale lender. So
Right.
we cater to the brokers.
Yeah.
But, so if you're a broker, I would say go for those jumbo deals because you're paid on bips. Duh. Right. It makes sense.
Yeah, you're paid on bips. That's it.
So,
yeah.
And I've found too, working on the smaller loans and the bigger loans, that literally the bigger loans are easier to do because this is kind of weird, but sometimes, if you have a CPA, you have accountant, you have assistants, you're just going to have more help.
Yeah, you typically have a more sophisticated support group to get you the information you need, right?
Yep, so absolutely.
Most of them are with CPAs. Most of them, have that support.
And I wonder if you closed a loan for, say, an entrepreneur, and that entrepreneur was stoked on your, on what you did for them.
Yeah.
Like, why wouldn't we ask that borrower to introduce them to their CPA? I mean, you already got you might not have their tax returns and you might not have been introduced because you're doing a bank statement loan, but you could say, oh, you do need a CPA letter. So that might be a good way to go, is to call.
Well, or how about just send the closing package to the CPA with introduction. Hey, we have a mutual client. And so then the CPA isn't looking for that later.
Right, 'cause you're gonna need it anyway.
Just do it as electronic file, right? Say, hey, get permission from your borrower to send it, but say, hey,
That's
I want
a great idea.
Yeah, here's the closing package. You're going to need this at the end of the year. I know it's always tough to get. Let me make your life easier. Here it is, and here's my contact information.
And just put, we specialize in self-employed loans, something
That's
like that.
it. Boom. That's it. Yeah, it's a huge deal.
I never thought of that.
It's we do get that occasionally, and we always remember that. That's always
very cool.
Shortcuts that
do
whole
that.
process.
That will get you loans.
That'll
right?
get you loans. 100%. 100%. That'll get you loans.
That's cool. All right.
Yeah.
Anything else you want to leave with us?
No, I mean, thanks for having me on the show. I think it's a great show. I watch it all the time, so it's a pleasure to be a part of it. And I think you guys are doing great stuff.
Thank you.
Yeah.
Great to have you on, man.
Thank you, man.
See you on the next episode. Thank you for listening to our podcast. If you guys are looking for more content like this, we have a Fund Loans YouTube channel where we give away more tips, secrets, and origination ideas. You can also email us at info@fundloans.com. And if you've made it this far, I think it's safe to say you like our content. So please subscribe, share, and send us your scenarios. Let's fund loans together.